I've been in the insurance industry for about 10 years now, and it seems that whole life insurance is just one of those things that remains to this day very controversial. And there's two different camps of advisors that seem to be on one side or the other, where one camp says, you know, it's the devil, buy term and invest the difference. It's a waste of money. It's a scam. Stay away from it. And the other camp of advisors, you know, that's the infinite banking, be your own bank, invest in whole life insurance, say it's the secret to becoming wealthy. And everyone that doesn't follow this is just a sheep and you're trusting the banks and the governments, etc., etc. It can be very hard to actually determine if this product is right for you or not. And in today's video, I'm going to be going over the good, the bad, and the ugly of whole life insurance. And by the end of it, you'll know exactly if this product is the right product for you or not. What is up, guys? For those of you new to the channel, my name is Philip Sutter. I'm the founder and CEO of Affinity Life, where we've helped thousands of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting, I'll put a link in the description below and you can check it out. But let's just get right into the video. So I read an article the other day, and I'll see if my editor can put it here on the screen for you, but it essentially said something like this. Pardon me. It said, I'm 26 years old. I bought a $1,500 a month whole life insurance policy from a friend last year. I want to get out of it, but it'll cost me $6,500 to surrender it. Did I just get scammed? And reading through the article, I'll post a link for it in the description as well, and I'll hopefully put some little blurbs up there on the screen. But reading through this article, you can tell that number one, it's written by someone who isn't in the insurance industry, but more importantly than that, number two, if you look at the comments, you'll see, again, like I mentioned at the beginning of this video, it's completely divided. You have one side saying like, no, he didn't get scammed. That's a great place to put your money. Keep going with it. Like, save it there. And the other party is saying like, absolutely, you got scammed. Cancel that right away. Get out of this type of policy and invest your money into something else. Now, it really got me thinking about, why is whole life insurance so controversial, and why does it seem like there's these two opposite camps? Like, how can there be people that so vehemently believe that this is true and then this is also true? And here's my opinion on that. Now, one of the reasons that I think that whole life insurance is a heavily debated topic, and it does get sold so much, is, I mean, whether you like it or not, the commissions. So the commissions with whole life insurance and all life insurance in general, but specifically with whole life insurance, they're higher than you would make with a term life insurance product, and they're usually going to be a higher premium as well. Term life insurance is relatively cheap. You might get a policy for, you know, anywhere from $50 to $100. It's going to be pretty low. Whereas whole life insurance, now you're able to pitch a much higher premium to those clients. It could be $500 a month, or like in this example for this guy, $2,600 a month, could be $10,000 a month, could be whatever number you're looking at. And of course, we get paid based upon how much premiums are sold. So we are, as insurance brokers, incentivized to sell a higher premium. However, the difficulty with trying to figure out whether whole life insurance is a scam or not kind of goes a little bit more in depth. So first of all, and I'm going to explain how whole life insurance works a little bit later here, but first of all, with whole life insurance, you have these two different sales pitches. So the first pitch is just permanent life insurance. So that's, hey, I want some type of permanent coverage. I don't want term. I don't want it to expire at age 60. I want to put my dollars in and know that whether I die at 60, 70, 80, 90, or 100, I'm going to have a permanent life insurance coverage in place. And whole life insurance does facilitate that. And that's one of the sales and marketing pitches. The other side of that now is this kind of messy area. And I'll explain how all this works. Don't worry. But that's this now quote unquote investment side of this insurance policy. And that's where it gets a little bit confused. And you may have heard this before, maybe not, but people with like infinite banking, be your own bank, invest into a whole life insurance policy, supplement your retirement income. Those individuals are now talking about life insurance as an investment. So building that cash surrender value and then borrowing against it to supplement your income, or buy real estate, or buy other investments, or fund your living expenses, whatever it is. So now it gets really complicated to say, is whole life insurance right or not? Because we have these two different components that we're pitching it for. Is it right as a permanent coverage? Is it right as an investment? And often they get commingled into one, and it's kind of hard to differentiate between the two. Now, to make matters worse, there's also just other variables that are very important and need to be taken into consideration regardless of which component you're looking for. And a few of those variables are, A, what other type of investments do you have? Now, this is very important. Are we talking about an individual who hasn't maxed out their RSP or their TFSA? Maybe, you know, they're making 60 grand, 70 grand a year, and, you know, they don't have that much left over at the end of the day. Or are we talking someone who's making 200 grand a year? They've maxed out their RSP, they're maxed out their TFSA. And then that leads me into the second component is, well, what's their marginal tax tax rate, because again, the investments and the returns and the growth of a whole life insurance policy, and I'm going to explain how this works, don't worry, can grow tax-free within certain limits. So when you're comparing that to a non-registered investment where you're in a very high marginal tax bracket, it can look very beneficial. But again, going back to the previous example with the individual who's maybe at 60,000, hasn't maxed their RRSP or TFSA, well, now their marginal tax rate that they would have within their investment, like such as a TFSA, for example, would be 0. So that's one of the variables that you need to consider. And of course, the tax rate is the second one that you need to consider. And the third one that you need to consider is, what are your goals? So is permanent life insurance a goal of yours? Or maybe it's saving for a house, or maybe you want to have some type of investment accounts, or maybe you want to buy a vacation property down in Florida. So again, the three variables are, what other investments do you have? What marginal tax rate are you in? And what are your goals? And then again, to further expand on that, you also have the two different components which may or may not be important to you, which is 1, the permanent life insurance coverage, and 2, the investment component of this policy. Now, I'm going to go over quickly how whole life insurance works, and I'm not going to get incredibly in depth, but I will kind of explain the basics of how it works. I have a bunch of other videos on the channel, and hopefully throughout the video, when I go through the good, bad, and the ugly, I'll explain a little bit more about these. But essentially, in a nutshell, whole life insurance is a type of permanent life insurance coverage here in Canada. We have term life insurance, we have whole life insurance, and the third one is universal life insurance, which I will talk about in another video. Whole life insurance is a permanent type of coverage, and the benefits of whole life insurance is that a lot of the features within it are guaranteed. So the easiest way that I can describe it is it's similar to buying a house or paying down a mortgage. So with whole life insurance, you have these two different components. One is the death benefit. That's very easy to understand. If you pass away, your beneficiaries get paid out this death benefit. The second component now is this cash surrender value. Now, the easiest way that I describe the cash surrender value is it's similar to the equity that you would have within your home. So if you bought a house, you're paying down your mortgage, you have some equity within the home, you can't just go and swipe a credit card and use that equity. You would have to either A, sell your house, or B, get a home equity line of credit against that equity. So it's very similar with the cash surrender value within a whole life insurance policy, where there's 3 different ways you can access it. 1, you can surrender your policy. So you can say, hey, cancel my policy, pay me out my cash surrender value, and let me go on my way. Or the other 2 are taking loans against it. One is a policy loan, one is a collateral loan. I'm not going to get into the specifics of how they work, but essentially you're taking a loan against the value of your insurance policy, your whole life insurance policy, and loan rates typically range anywhere from prime plus maybe 1% or 1.5%, but somewhere in that range. And you can usually borrow up to 90% of the cash value. So if you have $100,000 of cash value in your whole life insurance policy, you can borrow up to 90%. Now, most whole life insurance policies will have some type of payment period. Now, this is one of the really cool features about whole life, is it's contractually obligated for whatever period you pick. So let's say you picked a 10 pay, for example. That means that your payments are guaranteed for 10 years. You pay for that duration. If you die within those 10 years, of course, the benefit is paid out. However, at the end of the 10 years, just like a mortgage on your house, similar to whole life, now it's paid off completely. You no longer have to pay the premiums. And whenever you pass away, whether it's 20 or 30 or 50 years down the road, you'll have that benefit paid out. Now, the last component about whole life insurance, and I'm not going to get into it too in depth with this, but you essentially have different dividend options that you can choose when you start the policy that can affect the growth of the policy in different ways. With one of the most common ways you can structure it is something known as paid up additions. What that means is you initially will purchase a face amount, and a cash surrender value will be at a certain amount in the early years, and then over time, all of those different amounts will grow according to the returns of the insurance company. They're then going to receive those profits and return it to you as a policyholder in the form of this dividend. And as I mentioned, paid up additions is where your face amount will grow over time, and your cash surrender value will also grow over time. So maybe when you start the policy, you pick, let's say, a 10 pay, you're paying $10,000 a year. You start out with, let's say, maybe $150,000 benefit. Your cash surrender value in the early years is a few $1,000s. Over time, maybe 30, 40, 50 years later, your cash value could grow to maybe $300,000 or $400,000, and your death benefit could grow to maybe $1 million over that time period. So you're probably thinking, okay, this sounds really good. We have cash value. I can pay off my policy in a certain amount of years. Everything's contractually obligated. This sounds like a great policy. What's the downside of it? So now I'm going to get into the good, the bad, and the ugly of this type of policy. So number one that's good for whole life insurance is it's a very easy permanent life insurance insurance product to understand compared to universal life insurance. And I'm going to make other videos about that. But whole life insurance, it's very simple. It's easy to understand. You have a payment period that's contractually obligated. You have a death benefit, which is contractually obligated, and you have a cash surrender value that's contractually obligated. So you don't have to worry if your investment returns are going up or down. You don't need to worry about your cost of insurance. You just come to me, you say, hey, I want to pay for 10 years or I want to pay for 20 years. I want to pay $5,000 a year. You know that unequivocally, after 20 years, you're done paying for this. It's guaranteed. Number 2 is whole life insurance can be a very effective estate planning tool. So if you know that you're going to have some taxes upon death and you're going to have some liquidity for your estate to take care of those taxes, whole life insurance can be a very effective tool for making that type of estate planning. And number 3, we didn't really talk about that too much in the basics of whole life insurance, but the cash surrender value within a whole life insurance policy can be a very effective buffer asset, especially during retirement. So what do I mean by that? Let me explain what that means. As I mentioned, there is that investment component that a lot of other brokers will pitch. This is a way that I think it can be used very effectively. So the cash surrender value within your whole life insurance policy is what's known as a non-correlated asset. What that means is once you have accumulated value within your cash surrender value, it can't go down. So it's not correlated to the market. If the stock market goes up 10 points and down 10 points and up 30 points, your cash surrender value is going to remain fixed. So where I believe this can be used very effectively is during retirement. If you have a portion in your cash surrender value and then you have your other portfolio, most individuals, when they get to retirement age of 65 or 70 and they have their portfolio of RRSPs or TFSAs or whatever it is, non-registered accounts, they start to think, well, maybe I should now switch a lot of my portfolio from equities, which of course we understand has a high return, down to something like a fixed income, which is safer, less volatile, but has a lower return. So of course, if we do that, we're going to get less returns, but we're going to have a safer portfolio to withdraw an income from during retirement. So one of the things that I really like about whole life insurance and the cash surrender value as a buffer asset is now we can keep our portfolios still in some type of, fixed income equity position with a higher equity ratio, getting those higher returns. And if we do have a down year like 2008 or like pre-COVID or during COVID, we don't need to pull in income from that portfolio. We can just let it rest, let it breathe and recover. Because if you do pull in income while you're in a down position, it can take substantially longer for it to recover. So just leave it alone, let it recover, and then you can pull your income that you need year to year from your insurance policy. And then once your portfolio recovers, we can either A, repay that loan that we took, or B, we can essentially capitalize it and it gets paid off from the death benefit when we eventually pass away. However, there are some bad things about whole life insurance. Of course, starting with number 1 is the premiums are substantially higher. The premiums compared to term life insurance for the same death benefit will be anywhere from 20 to 25 times more expensive. So if you're looking for $1 million of coverage, especially during the years that you need that, maybe age 30, age 40, let's say it's $100 in a term product, it's going to be $2,000 to $2,500 in a permanent type of product. Number 2, of course, there's just way more complexity compared to term. It's more simple compared to universal life insurance, but it's way more complicated than a term life insurance product. Term doesn't have any cash value or policy loans or collateral. You don't need to worry about your return on investment. You're paying a relatively low premium for a death benefit. If you do pass away during that period, of course, it'll be paid out. But whenever you get to the end of your term, the idea is that you don't need it anymore and you can cancel it. Number 3, especially with whole life insurance, is you may get stuck in this sunk cost fallacy. And this is something that you need to be careful of. Going back to that article that we read of this individual paying $2,600 a month, of course, after a certain amount of time, let's say year 1 or 2, you haven't recovered your income or your profits back, or your value, back. You're going to start to think like, I've already invested, whatever, 10,000 into this. If I cancel it, I'm not going to get anything back. Let's just stick with it, which is not necessarily a good thing to do, especially if you run the numbers and it's more beneficial to just put that in your TFSA. Sometimes it can be difficult to do that. Again, with that sunk cost fallacy notion, you think I've already put the money in, let's just stay with it. When in reality, maybe it should be time for you to just cancel it, cut your losses and move on. And the number 4 bad thing about whole life insurance here is there is a policy loan risk specifically in Canada. So I mentioned there's 2 ways that you can get a loan against your whole life insurance, the cash surrender value. One is a policy loan, one is a collateral loan. A policy loan is directly with the insurance company company, and a collateral loan is where you actually go to a bank and you pledge that asset to the bank. So a policy loan here in Canada is considered a disposition according to the CRA. So what that means, to make it simple for you guys, is in those later years, age 60, 65, especially 70 and onward, there's a high probability that the policy loan will not only have an interest cost associated with it, but also it will be taxable. You'll get taxed on that loan each year that you take it, and you'll recover those taxes if you repay the loan. However, that can be very punitive to not only pay an interest cost as well as taxes on a policy loan that you're taking, especially if that was part of your financial plan. Now, a collateral loan isn't considered a disposition according to the CRA. However, it is a lot more difficult to get than a policy loan. A policy loan is guaranteed. You can get it. There's no real minimum requirement. You don't need any debt service ratio or good credit worthiness. Whereas a collateral loan, it's not considered disposition. It's not taxable. You still have to pay the interest. However, you need to have a good credit score. You need to make sure your debt service ratio is good. And there's minimum requirements for a loan as well. So it's just a lot more difficult to get. Now, I did make another video specifically about how to take these loans. And if you are interested in that, I'll put it right there. I hope it's on that corner of the screen and you can check that out. Now let's get into the ugly of whole life insurance, the really bad parts of it, and where I think it really does fall apart. So number 1 and 2 are essentially kind of the same thing, and I guess number 3 as well. But the biggest problem that I have with whole life insurance is when advisors will pitch it, this very misleading pitch, as a one and done kind of investment. This is the best place to store your money, and they really forget all the other opportunity costs that you would lose if you actually just put your money into a TFSA or an RRSP. And I've said this again and again and again on my channel. If you haven't already maximized those accounts, especially when you're looking at this as quote unquote an investment, look at that very first and foremost. And then even then, as a permanent life insurance coverage, I would still look at this prior. Maybe you don't need to max out your RRSP and your TFSA, but definitely have them very well funded before you ever consider this type of policy. And kind of the last point here, just of the ugly quote unquote portion of whole life insurance, in my opinion, is it's pitched above all other planning. And I think this is kind of the biggest breakdown that I see sometimes with other brokers, is they will pitch whole life insurance as the holy grail, the one and done. Put all of your money into this account, where I think whole life insurance definitely can be a very valuable planning tool. However, it's just one tool. It deserves its spot, especially for certain individuals, and I'll talk about that at the end, who I think this is right for. It definitely deserves its spot there. However, this is just one component of your overall financial plan. You should still have your RRSP, your TFSA, pay off your high interest credit card debt and all your other types of debt that's a high interest rate. Have an emergency fund, save for your child's education, RESP. Have other types of investments to diversify from your paper asset portfolio, and other financial planning things that you should consider. And again, this is just one component, and I do see it often, especially in the infinite banking world, the quote unquote be your own bank, where this takes over the entire financial plan of an individual. And I do not agree with that. I think it's a very ugly side of this market. Whole life insurance has its place in the market, but it is one tool of your overall financial plan. So who do I think whole life insurance is right for? Well, I really think there's 3 individuals. Number 1 is that high net worth individual that is looking towards tax advantage growth within their policy and estate planning. And when I say high net worth, I'm talking about people probably in the 150 to 200 range. They've maxed out their RRSP, they've maxed out their TFSA, they have other things in place. And of course, again, this is just one tool within their overall financial plan. Number 2, business owners here in Canada. So there's some very specific, really cool tax advantages that permanent life insurance has within a corporation as opposed to owned individually. I'm not going to get into it in this video. I made another lengthy video about permanent life insurance and who it's right for in a corporation, what are the tax advantages of that, and I'll put that one there. But business owners, especially of course business owners that are high net worth individuals, owning a permanent life insurance coverage in the corporation can be incredibly valuable. There are some strings attached, so don't just run out and do it right away, but it can be incredibly beneficial for those individuals. And the last one, number 3, is people with dependents of lifelong coverage. So perhaps this could be, parents that have disabled children. They know that they're going to have to take care of them not only during the 10 to 20 years or 20 to 30 years while they're growing up, but after that as well, they're still going to have a financial need to take care of those children, whether it's, 50 or 60 years down the road. Of course, you still want to make sure the other things are taken care of, such as those registered accounts and maybe some other personal insurance and emergency fund and all that. But for those individuals, that could definitely be a good idea. So in conclusion, whole life insurance, like I mentioned, is just a tool like anything else. It definitely has its place in the overall scope of financial planning. However, it should not be used as the entire financial plan. It's just one tool, and it's right for certain individuals. So with all that being said, I hope you guys enjoyed today's video. If you guys have any questions or comments, just drop them below. And as always, if you guys are enjoying this, just give me a thumbs up, and I'll see you guys in the next one.